What are the pros and cons if Chip uses the money in his taxable brokerage account for early retirement income? Jack and Sally asked Joe and Big Al to spitball on whether they can retire around age 55 or 60 and whether they should max out their Roth or convert to Roth. That's today on Your Money, Your Wealth podcast number 527. Plus, April and Andy asked the fellows to spitball on their dividend investing strategy, and Don wonders if a separately managed account, or SMA, makes sense for his taxable account. We'll also find out what an SMA is. If you've got money questions or want your own retirement spitball analysis, click or tap Ask Joe and Big Al on air in the episode description and send us your deets. And do us a favor and watch the video on the Ask Joe and Big Al page to find out how to make your spitball a good one. I'm executive producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joy Anderson, CFP, and Big Al Clopine, CPA.
Okay, we got Chip Skylark from Dimsdale. What is that, Nickelodeon?
Nickelodeon cartoon.
I actually looked it up because it seemed like it had to be a fake name. And yeah, it's apparently from an animated series called The Fairly Odd Parents.
All right.
Okay. Well, we would have not have known that.
Very cool. So let's, we go, hey, Joe, Big Al, I was hoping you could help me think through some things with my taxable brokerage account. My wife and I are both 33 years old, and we have one child that's 9 months old, and we'd like some thoughts on any pitfalls or considerations as it relates to growing and then using a taxable brokerage account to supplement income before retirement. We both worked in IT consulting for about 12 years, both for large firms, and make about $300,000 combined gross salary before bonuses. Neither of us really enjoy our jobs all that much, but we've stayed in the field because of the good pay and the flexibility the job provides. One thing we'd like to focus on over the next couple of years is growing our taxable brokerage so that we can eventually take our foot off the gas on our IT jobs or shift to other careers entirely. We want to retire around 50. Here's our financial details. Our finances are fully combined. We own our home that we just purchased in 2019 for $375,000 that we fully paid off in January 2024. All right. So no mortgage payments and no HELOC associated with our house. We both own our cars. We have $470,000 in traditional 401ks, $130,000 in Roth IRAs, $10,000 in HSA, $15,000 in 529 plans, $27,000 in company stock from my wife's work, about $40,000 in emergency fund, and about $160,000 in our taxable brokerage. The retirement accounts are all invested per the efficient frontier. Oh, look at the big brain on Chippy. The efficient frontier.
I haven't heard that used in a while.
Will you explain that for us, please?
Yeah, Harry Markowitz.
Yeah.
Is that for every level of risk that you're willing to take, you should anticipate a higher expected rate of return.
There's a little graph that goes risk, and then with the more risk, you get a higher rate of return.
But then it plateaus.
It kind of levels out after around 60, 70%. I mean, you get a little bit more return, higher equities, but anyway, that's the whole point, is to think about the rate of return you need and the amount of risk that you're taking to get it.
And then you can plot it on a graph on the efficient frontier, and then that should pop out your optimal portfolio.
Yeah, and then next day it'll be slightly different because the market changes, but at least you get the idea.
So, yeah, efficient portfolio theory. All right, the brokerage account is okay to mainly set up of S&P 500 index fund. Neither of us have pensions. He's in IT. How the hell does he know about the efficient frontier?
Because he loves finance.
He's grinding on the blogs. He is doing everything he can.
I don't think we have mentioned that in our show for 15 years.
Yeah, Harry Markowitz. Love it. Nobel Prize winner.
Yeah, we saw him speak, didn't we?
Yeah. It's pleasant if you'd like to fall asleep. We used to do a little speech by Harry.
It's a little dry.
Oh my goodness gracious! Smart as hell. But wow.
Yeah.
I mean, I maybe got 3 words there.
I was.
Could you imagine me reading like?
Which is amazing because you reeled off that description of the efficient frontier just like you had it by rote. So I figured that you had like studied this thing backwards and forwards.
Well, we learned the cliff notes. That's all we really needed.
Through finance classes, and I do have a degree in finance. I do have a certified financial planning designation.
Really?
Yeah. I've been doing this for 25 years.
Got it. Okay.
I know I sound like an idiot on the podcast, but it's all for show.
It's all for show.
Yeah.
It's all for laughs.
I did, yeah. I do read every now and again. I read. Here's my
Your
weekly reading.
So if you want to join a book,
What's the last time you read out loud? You know what I mean? People give me shit all the time.
I don't
It's
like reading out loud.
No, people read. They're not reading a novel and their books out loud
true. Good point.
on camera.
Yeah. So if there was a book club, it would have to be questions because you wouldn't read otherwise.
I would never could a book club. Could you chapter
We're
one?
gonna-
Well, where's
we're-
the question? Oh my
we're gonna-
God, this one's going on and on and on.
Our book club today is episode 469.
Oh man. All right. So we paid off our house a little over 4 years and we saved $100,000 into our brokerage account in 2024. Wow.
That's great.
Incredible. With all our extra funds pointing that direction. So once we have our eyes set on a financial goal, we usually hit it. Oh, no doubt. Chip here makes 300 grand
Yeah.
and he could save 100,000. The other 100 goes to taxes and he lives off 100.
Yeah.
A
Right.
third, a third, a third.
Yeah. But that's right.
Pretty good. But no, he's saving 100,000 just in the brokerage account.
Yeah. So that's on top of his
His
401k.
401ks.
Yeah.
All right.
Very good.
God, wish I had that discipline when I was 33.
Yeah. I was just getting married.
Yeah.
Kids. Didn't have the extra money.
Yeah. I was a little later than that.
Last year.
Are you? Yeah, it's just my honeymoon.
Yeah.
A couple last week.
Anniversary.
Our yearly expenses are usually around $80,000, but with daycare costs and other baby expenses, we're expecting it to be $100,000 to $110,000 over the next few years.
Okay.
All right. What are some of the things I should be thinking about to take into account as we continue to pad our taxable account so that we can ease off or make a change? Obviously, we'll start getting dividends and capital distributions and may need to put quarterly taxes to keep them from going to Uncle Sam. Let's see. But outside of that, what is there? Is it as simple as building up an account as far as we think we need and then drawing down and take care of expenses? By the way, my wife and I drive Subaru Foresters. No, the wife drives the Subaru.
Yeah.
Where are they from? Seattle? Where are they from?
Dimsdale
Dimsdale.
Dimsdale.
We're not
That's
sure.
guaranteed. Dimsdale.
from Nickelodeon land.
Yeah, an old Honda CRV. I enjoy spicy cocktail that burns.
Ah,
Oh, what's that? Fireball.
probably. That's one of yours.
Oh yeah, I'll drink some Fireball when I get a birdie, and I birdie a lot.
Is that
yeah?
That's a requirement on your rounds,
birdie
right?
juice.
Birdie juice.
My wife, red wine, and we both like a little hazy IPA.
Yeah, me too.
Thanks for your help, and please keep up the good work on the show.
So what else can Chip do?
All right, well, so let's talk about this because I'm glad. So Chip is saving his tail off into a brokerage account.
Right.
This is interesting to me because Chip has already saved a ton of money. Chip has $500,000 saved, more than that.
Yeah, half
He's
a
got
million in a 401k at
He's already
33.
got 700,000, almost $1 million saved
Yeah.
in a retirement account, a Roth account. And so when people put money into a retirement account, it's like, okay, well, here, I'm going to pick some mutual funds. And it's like, they feel a little bit more confident saving in the retirement account. They pick the funds within the plan, and then they put dollars in every week, and then they let it go.
Right.
Most people do not have the discipline, or they have a little bit more intimidation by investing in a brokerage account, and it's exactly the same.
Right.
You invest exactly the same. You want to be a little bit more tax sensitive. And we could get into the tax strategies, but it's not like, here, I want to invest in my brokerage account a little bit differently than I do with my other investments, especially at 33 years old. You already know the efficient frontier. Find that in frontier and get on the line.
Yeah, I would say, Chip, you're doing everything great. Keep doing what you're doing. As far as, yeah, saving in a brokerage account after you've maxed out your retirement accounts, and favor the Roth IRA, right? Because you got money in Roth, but get some more. Favor that Roth IRA in the 401k, the Roth option in the 401k. But as far as your brokerage account, yeah, go ahead and continue investing, as Joe said, like you do before. But now look at things like tax loss harvesting when stocks or mutual funds, ETFs, when they go down in value, you sell it, create a tax loss, buy something similar. So you're still in the market, but you've created a tax loss to net against other gains. As far as your bond money, your safe money, invest in muni bonds because there's no taxes. And if you invest in muni bonds in your own state, you don't pay any state taxes or federal taxes. So those are a couple of thoughts there. But mainly, Joe, I would just say keep doing what you're doing.
Absolutely. I mean, he's doing the research. He's overstudying this.
Yeah. Well, he knows the stuff.
At 33, you want to continue to build. And so here's another thing. If he wants to retire at age 50, right? So I would just look at, okay, well, what is the dollar that you want to spend at age 50? What is the living expenses? It doesn't seem like they spend too much. I think they got their expenses under control. They paid off their house in like 4 months.
Right.
And then he's just jamming everything into a brokerage account.
Yeah.
It's all right. You want to retire at age 50. How much money are you spending today? And then it's like, all right, well, how much money do you need to bridge the gap from age 50 to probably age 70 when you claim your Social Security, which would be 20 years?
Yeah, and make sure you have enough in a brokerage account to age 59 and
or
a half.
60.
Or 60, yeah.
So, yeah, you got a 10-year bridge to get from 50 to 60. So if you're spending $100,000 a year today, right? So just inflate that until you turn age 50. And then you look, all right, well, I need 10 years of that number. And it probably would be best if it was in a brokerage account that I could live off of as I'm having my other retirement accounts grow. That's the easiest way to think about this in regards to numbers and how much money that you should be saving. But I think a better way too is that you want to be diversified. And what we see a lot of times when people retire early is that they drain all of their non-retirement assets, and then all they have left is retirement accounts that are all taxed at ordinary income rates. So having diversity from a brokerage, Roth IRA, and a tax-deferred account, can really control taxes long term. So I think he's on track. I think
looks like
right now, over the next 5 years, just save as much as you possibly can in the brokerage account. Don't overthink it. Because it's in a brokerage account, it's closer to me, right? I can grab at it at any time versus a retirement account. Oh, that's long-term money. Think of it both as long-term money and invest it very similar for growth, but you just probably want to take advantage of some, tax techniques along the way. Tax loss harvesting, being a little bit more tax-efficient investments, ETFs. Just understand kind of distributions from dividends, cap gains that might spit out of retirement or mutual funds. So.
Yeah, I'd also say think about a potential 72T election, right, on an IRA at age 50 as a possibility to help bridge that 10-year gap until 59 and a half. Brokerage account is a great way to do it. But the last thing you want to do is what Joe said, which is completely use up your brokerage account, and then you get to 59 and a half, and it's mostly taxable. So just be careful of that.
Only about 1 in 10 Americans are living their definition of financial freedom. 54% say that means living debt-free. 50% say living comfortably. 32% say financial freedom means not having to work. And 13% define it as being rich. But too many of us fall short of financial freedom because of lack of retirement savings, salary constraints, debt, or unforeseen emergencies. This week on Your Money, Your Wealth TV, Joe and Big Al put you on your 11-step path to financial freedom. Find out how to take inventory, invest in yourself, and sustain your financial dreams and goals. Our financial blueprint tool will help you with that first part, taking inventory. Click or tap the financial blueprint link in the episode description. Enter your details, and you'll get an analysis of your current cash flow, assets, and projected spending for retirement, along with 3 scenarios that'll help you determine your probability of retirement success. Click or tap the links in the episode description to watch your 11-step path to financial freedom on YMYW TV and to calculate your financial blueprint.
We got Andy and April. Hey, Joe, Big Al, Andy. Per Andy's instructions, my wife and I have $366,787,000 saved in a Roth IRA. What?
Very specific. All I said was we need how much you've got in taxable, tax-free, and tax-deferred, and he's given it to us to the dollar.
Yeah. Wow, to the penny here.
Yeah.
We need to know what day that was because it's different.
It's different today. We got $305,453 in a traditional account and $352,543 in a brokerage account for a total of $1,024,783.
Yeah. And by the way, you can round. It's okay.
Joe
We
does
are
all the
30
time. I'm surprised
we
that
are
he's reading them
34.
completely now.
6 months, 7 days, year old. My wife is 33, 4 months, 27 days old. So we do not plan on receiving any money from the Ponzi scheme referred to as Social Security. Oh,
we're getting
wow. Here we
political.
go. Little political bash with the person that's super accurate with his numbers.
Right.
Ponzi scheme. I suppose every 30-year-old guaranteed has called Social Security a Ponzi scheme.
Probably.
I think I probably did when I was 30.
Yeah, I probably did too. And here it still is.
Here we are. I'm, 5 years later.
5 years, huh? Well, you've
I've
aged.
grown up. I've grown up quite a bit. Okay, we currently spend $86,000 a year in Knoxville, Tennessee. Oh, okay. I drive a 2012 Subaru. April drives a 2012 Subaru, and I drive a 2014 Jetta.
Okay.
Sure, you guys don't live in
Colorado.
Portland?
Portland.
I drink Heineken. And April is pregnant with our first child, so she's not drinking, but she likes seltzers.
Okay.
We have
So does
recently
Joe.
started. Yeah, I do like seltzers. Only like Truly.
Truly.
White Claw can't even drink it. Any other flavors, they all taste the same to me.
Really?
I tried like Happy Dad. I thought that was kind of cool.
Yeah. Because you are a happy dad.
I am a happy dad.
So you think that
I was like, hey, this is kind of like me. I'm gonna have a little happy dad. Yeah, you have 2 of those, and it's like, nope.
Yep. Okay.
So, I could tolerate like the lemonade, the Truly lemonades, or the fruit punches.
Okay.
Anything else? I'm going to Coors Light.
I will stick with beers and Mai Tais.
Got it. Okay. All right. So let's see. We're back to April and Andy. We have recently started thinking about how to plan for spending in retirement. We listen to your show. I frequently hear the 4% rule rate is considered safe. One of the strategies we have read about is living off of dividends. My understanding is that the dividend strategy invests in ETFs, which have higher dividend yields relative to the S&P 500. The investor uses the 3 or 4% yield to live off of, and the principal is not eroded due to the stock value increases. This leaves us with a goal of saving $2.1 to $2.9 million to replace our current spending needs. I understand that inflation and having a child will increase our spending, but the previous mentioned funds have dividend growth rates that exceed inflation. My question is, what am I possibly missing, not accounting for, or misunderstanding if the pursuit of dividend investing strategy? I'm always entertained by your show while I'm commuting to work. I appreciate the show and the education resources you get. Excited about retirement planning. Thanks. Andy and April, Parks and Rec reference. Got it.
Okay.
I haven't watched the show, so I don't know who they are.
Oh.
Well, you got that on the screen. Okay.
Yeah, that's Pratt, Chris Pratt. That's the guy from the Avengers.
Ah.
Well, apparently he's also from Parks and Rec.
Yeah, Guardians of the Galaxy. You should see him now, man. He's like jacked.
Yeah,
ripped.
he is, isn't he?
Yeah. All right, very cool. April and Andy. So dividend paying stock. So here's the 4% rule, is that it's by no means gospel.
Okay.
It helps people determine, in my opinion, how much money that they should have at retirement. So if I'm looking to spend X amount of dollars, you just take those dollars and divide it by 4%. That's going to give you a lump sum. If I want to spend $40,000 in retirement, 40,000 divided by 0.04 is $1 million. So $1 million should produce $40,000 of income. But that's a rule of thumb. You don't necessarily want to take 4% out every year because it's going to depend on sequence of return risk. It's going to be dependent on how much tax that you're actually paying on the distribution, how big of a nest egg that you have. It's going to have a lot of different variations. But the problem is, let's say I have $1 million. some people will spend $120,000 a year from that $1 million,
Yeah, which would be at 12%.
which would be 12%, which would be way too much because a 4% is like, all right, this is a safe withdrawal rate. But in my opinion, you want to have a more dynamic strategy as you're creating income. But when you're spitballing to see, hey, are you close? Do you have enough money? Let's just divide it by 4% or times that number by 25. That's going to give you a ballpark number to say, all right, well, here, if you have $1 million, $40,000 is probably a good estimate of how much income that you could probably take. The second question he's asking is that, okay, well, what should that portfolio look like? Now that I got my $1 million, or in his case, $2.1 or $2.9 million, how should the portfolio look? Should I buy dividend paying stocks and live off the dividend, or should I do something different? So I think that's really the question at hand.
Yeah, I think that is the question, and we've heard this a lot, and it's not necessarily a bad strategy, but here's something you might want to think about, and that is companies, public companies in the United States, their goal is to make profits, and some of those pay dividends, large, some medium, some small, some don't pay any dividends at all, and that's not reflective necessarily of their profit. Like Berkshire Hathaway, for example, Joe, they don't pay any dividends and they're very profitable. And so what you do in a case like that, when you have a company stock that doesn't pay big dividends, is you just periodically sell chunks of it. That's called a synthetic dividend. You create your own dividend because if you get high dividends from stocks that you don't need, now you're paying taxes on money you don't really need. If you have companies that pay lower dividends, you can create the income you need by selling the shares when you need it, and thereby you're getting enough to cover your needs. So that's one thing. My second quick point is this: if you're only looking at high dividend paying stocks, you're kind of missing out on a lot of companies, whether they be domestic and international. And we think you do better with a full globally diversified portfolio.
I absolutely love dividend paying stocks. Right, but I love a lot of other stocks too. So I want to own these dividend paying stocks, but I want to own more. Here's a couple of things that you might not understand too, is that when a company issues a dividend, the stock price lowers by the dividend.
Yeah, a lot of people don't realize that.
For instance, let's say a company is worth $10 a share and they give $1 dividend. The share price, as soon as they distribute the dividend, goes to $9. So it's the same as if you sell a share of a stock that doesn't give a dividend or doesn't produce a dividend. And people are like, what are you talking about? There's no way that happens. It's like, yes, that's what happens. They're distributing capital or cash from their organization or company. So the share price measures whatever that dividend is, and it adjusts the share price on X dividend date. But what happens sometimes is that the stock price will exceed the amount of the dividend in the day that it happens. And they're like, well, no, my stock price is the same or it's low or whatever. But no, how it works is the share price will fall as the same as the dividend.
Yeah, I mean, how many times have we heard that argument? That's just not how it goes.
I just want high dividend paying stocks because I'm just going to live off the dividend and the principal will stay constant.
Yeah, and so by definition, the stock price goes down, and the stock price goes down. If you don't understand this, you might just think, if you're checking it that day, you might think, oh, I guess the market's down today. That's why, because of the dividend.
Right.
Or if your stock went up on an X dividend date, it's because the market went up more than the dividend was. So it's just realize that whether you get the dividend or not doesn't really necessarily affect whether it's a good investment or not.
Yeah, good point. But I think there's a lot of really good companies that offer really good dividends. But to Al's point, from a tax perspective, is that you can control your dividends too. So in my example, if the company has a $10 share price and it's giving a $1 dividend, so you want to live off of that $1 dividend, the share price goes to $9. Let's say you have another stock that doesn't give a dividend and you don't necessarily need the income. So you have a $10 stock, it doesn't give the dividend, guess what? That's fine, right? It stays at $10. So you didn't get the dollar in hand, but you didn't necessarily need the dollar, so you're not getting taxed on that dollar. Or if you want the dollar, you can create that dollar at any moment in time by selling one share and taking that dollar. Now, of course, that stock price or that stock is going to be less $1, but it's the same as a dividend paying stock. So you want to take a look at the total expected return of the overall asset class, the overall company or sector or whatever. If you're investing solely in dividend paying stocks, it's a small universe of the entire stock universe. And I think that might be maybe a little bit too concentrated, a little bit too risky. And I think a lot of individual investors, they hear dividend paying stocks, and so they kind of crowd that marketplace anyway. So you look at some of these ETFs that are dividend paying stocks, retirees say, hey, I want dividends. So they're buying these ETFs, and that could be boosting up the share price of those particular, asset classes as well. So, all right, cool. We'll beat that one to death. Let's move on. We got gentlemen Jack and Sally here, just discovered your show and love it. We get a lot of people that just discover the show and they love it. And then we get people that listen to about 2 months and they hate it.
We've had a few of those.
So
I tried. I listened to you a year ago. I thought I'd try it again. It's just as bad.
It's so bad. All right. So I'm glad that you just discovered it. Stick around. It only gets better. It's like a fine wine. I could smash some cab. And my wife loves a nice little Pinot. Little cab and Pinot group here.
Yeah.
All right. We live in the beautiful hills of Western North Carolina with our 13-year-old daughter and 2 little pups. By the way, I drive an old Tacoma. My wife drives an old Dodge. I have 2 questions. Okay. 1, is it realistic to think I could retire somewhere between 55 and 60 if I'm running out of juice for my job? All right, he's getting sick of it. Wants to get the hell out.
Yeah.
Once the house is paid off, should I try to max out all Roth options right now, or should I just focus on converting my existing traditional IRA to a Roth? I'm a teacher, so I'll try to fill up that Roth 401k and Roth 457 after the house is paid off, or should I focus on conversions? WAG.
What that is?
What? No.
Wild
WAG.
ass guess.
Wild ass guess.
Oh, I would have had no idea.
Okay.
I had to look it up.
Wild ass guess. We'd like to spend about $10,000 a month in retirement after the house is paid off. My daughter has a little 529 plan she will receive from my GI Bill for college if she chooses to go. With my pension, I think we're doing well as long as I stay alive. I'm actually concerned about my wife's lifestyle once I'm gone. What? I'm hoping to live a long time, though. Well, yeah, me too. What is it? Like we get to a certain age and we always think we're going to die.
Well, we have to start thinking that way. And that's it. We're getting there about your age.
Whoa. Hey
It was
now.
fighting words, Al.
Hey now.
I said about.
Got it. We'll need new cars and a new roof in the next 5 to 10 years. Here's the details. Jack is 52, Sally's 51. Current pension, $100,000. When I pass, Sally gets 40. Current salary, $80,000. Maybe some scraps from Social Security and teacher's pension once I turn 62. We got checking, brokerage, Roth IRAs, traditional IRAs, and so on. So a total of tax-deferred accounts of $500,000, taxable accounts of what, $100,000, and tax-free Roth is 1.4. Is that right?
Yeah, about 1.4. Yep.
All right. Yeah, man, you're doing a hell of a job. Pension of $100,000. He wants to spend $10,000 a month. You're good.
Yeah, I agree.
Yeah, you can retire at 55. I get it. All right, so you're worried about your wife spending once you're dead, Jack. So then Sally's going to spend now $200,000, but the pension is not going to come up with 100. It's only going to give her 60.
Yeah, or 40%.
Oh, 40%. Okay.
Yeah, I think this is fine too. If it were me, I would try to get a better survivor benefit for my wife. That's
But it's already picked, selected. It's done.
if you can change it. I
think that's his
think that's a one and done?
GI Bill, TSP. Has he got a
Uh,
TSP, IRA, current pension?
Well, it's
I wonder where the pension's from.
well,
The employer now?
he's a teacher, right?
Oh, it's a teacher. Okay, so North Carolina teacher system.
Yeah, I mean, we don't know.
So instead of $100,000 pension, probably go 80,000 and give her the 80,000.
That's what I would do.
Yeah,
Especially because you got the resources otherwise.
right. Well, let's just see. Let's do the math.
Okay.
So he wants to spend that's $120,000 a year, and they want to retire in 5 years or 3 years,
Well, he's
52.
52, and he's thinking
somewhere between 55 and 60.
So
All right.
let's call it 5 years from now.
Okay, so $120,000 All right, so let's just say 5 years from now. Let's say 3.5% inflation, so that 120 is going to turn to 142.
Yep.
Let's just assume that then he passes away and she only gets 40% of her pension, so that's $40,000. So she needs to come up with $100,000 to live off of,
Yeah.
given the same lifestyle
Right.
with inflation.
Right.
You with me?
I'm with you.
0.04. So they need about $2.5 million. They got $2 million today.
Yeah.
I think even with the lower pension amount, if they're going to work for another 3 years, depending on, of course, what the market does, it's pretty close.
Yeah. Well, I agree. That's what I would do though, if I could. That's the way I would think about it.
So he's not even talking about that's the pension. So he's not even including Social Security,
No.
like some scraps from the Ponzi scheme.
So I guess he's assuming it's not that much because he's a teacher.
Sure. Okay.
Yeah. But yeah, I think it looks good. I think it looks really good.
Yeah,
And
a ton of Roth money. I mean, the taxes are going to be almost nothing
Yeah.
on any type of distributions. The RMDs are going to be nice. I think he's done an awesome job.
Me
I
too.
like this.
Yep.
I don't know. Is it realistic to think I can retire? Yes. Once the house is paid off, should I try to max out more Roth options?
So
Yes.
So Joe, here's an example of someone that will be in a higher than 4% distribution rate when they retire, but it's only for a handful of years. And then all of a sudden you got 100,000 coming in. So just think about that, right? So yeah, you can retire with a more than a 4% distribution rate if in just a few years you've got 100,000 pension or whatever the number is. So 4%, as we talked about earlier in the show, is just kind of a general guideline to tell you how much money you need to save for in retirement. And that's it.
Hey, Jack and Sally, our withdrawal strategy guide will tell you more about sustainable distribution rates, optimizing from which accounts you make your withdrawals and when, the impact of market volatility and inflation on your retirement spend down planning, tax saving strategies to make your money last longer in retirement, and more. And Andy and April, our 10 steps to improve investing success contains key investing principles that'll broaden your investment universe and help control risk, which can lead to higher returns in your portfolio and retiring with more wealth. Click or tap the links in the episode description and grab your copies of both the Withdrawal Strategy Guide and 10 Steps to Improve Investing Success. All free, all courtesy of Your Money, Your Wealth, and Pure Financial Advisors.
We got Don from Iowa. Does an SMA make sense for my taxable account? Hi, Joe, Big Al, Andy. I love the show. I've been listening for about 5 years, usually while exercising. I'm a 40-year-old with income of $300,000. Spice is 38, yo. He stays in the home to manage the household with the kids. We have just over $1 million in investable assets and savings, $330,000 our traditional 401 or 403b, 55 in the Roth, 58 in the Roth governmental 457, 170. Just say Roths, Jesus, 178,000 in our backdoor Roths. He's just labeling every Roth that he has. We
Yeah.
got the backdoor Roth, we got the governmental Roth, we got the 403b Roth,
In case they're
we got the
different.
traditional Roth. It doesn't just, it's all Roth. It's one account. Call it good. $410,000 in a taxable account. I have a pension with a COLA, $100,000 at 65. We are invested overall in a globally diversified low-cost index portfolio. I like to have the option to retire at 55 with an income from a portfolio of $170,000 in today's dollars. I was recommended to over a few-year transition my taxable account to an SMA for tax purposes and hopefully more growth. Okay, I'd love to hear your spitball on this. Thanks. Keep up the good work. Cheers, Don. Let me digest this.
Okay. Well, first explain what a SMA is.
Separate managed account. So he's 40 years old. He's got an income of 300,000, and they have a total of, I mean, I get confused with this Roth, that Roth, this Roth, backdoor Roth, whatever.
It's about $1 million.
Okay, he's got $1 million and he's 40 and 38.
Yep.
He wants to retire at 65 because he's going to have a $100,000 COLA. Or he wants to retire when? 55.
55.
All right, so he needs to bridge 55 to 65 and live off of $100,000, which would be, or he wants income of $170,000?
In today's dollars. So that's going to be a pretty hefty sum.
What the hell? So, all right, so 100.
I mean, first of all, you got to adjust for inflation, but then whatever you get, call it 250, divide by 0.04.
Okay,
What's that?
$170,000 is what he wants to spend.
Yeah.
So 15 years, 3.5 future value, it's 284.
280. Okay.
All
So
right.
what's 280 divided?
7.1 million.
Yeah. So that's quite a hefty.
So can that million turn to 7.1 million? That's going to help you create the 170,000. I don't think he needs that much. I'm
No,
guessing
he doesn't because
needs-
of the pension.
Yeah, because of the pension. So 70,000. Let's do this. 70,000. Point oh four. So that's 1.7. So he needs 1.7 when he turns 65. He wants to spend $170,000 in today's dollars.
Right. And you
That's
just compute it
280.
280.
So that's $280,000 times 10. It's 2.8 million of income that needs to be produced over that 10-year time period. 1.7. All right. So he needs 4.5. He's got $1 million. I think he can do that.
Yeah, with the way he saves, probably.
So the SMA, don't worry, the SMA again is just a product. Like someone wants dividend paying stocks, and SMA is just a separate managed account. So instead of buying a mutual fund and individual stock, or you could buy an ETF, or you could buy a separate managed account. They're all good and they're all bad, really, depending on what you're buying and what's the strategy? What are the costs? What are the fees? Do you know what the objectives are? Is it large cap? Is it small? Is it bonds? I mean, I really don't know what the SMA is, but an SMA is just a separate managed account. So that's like, hey, someone said I should get into a mutual fund. Is that a good investment? Well, is it a loaded mutual fund that's actively traded with a 2.5% internal fee? I would say absolutely not. Or is it an index fund that's covering the entire U.S. market? I would say, yeah, that's pretty good. So the product itself, it could be really good or really bad. It's just really understanding exactly what you're investing in, I think, is the more important question.
I would agree with that. And SMA it's another manager that's managing assets for you and picking the stocks for you. I personally like direct indexing better. It's still a source who's picking certain stocks, but they're trying to mimic an index. And so instead of the whims of someone thinking, okay, let's pick this one, let's pick that one, me personally, I'm a little more comfortable with trying to mimic an index. The nice thing about direct indexing, you actually own the stock shares, and you can tax loss harvest, and you can manage your account more easily that way. But Joe, probably for most people, just ETFs and index funds, globally diversified, is probably fine.
Yeah, SMAs are fine too. We offer SMAs to our clients.
Yeah.
So it could be passive, it could be active, it could be tax managed, it could be anything that you want. So I have no problem with the SMA. I just don't know what
the objective is. Well, he wants to get to whatever 5 million or whatever the number is.
But it's like, okay, well, here I would love an SMA for tax purposes and hopefully more growth. So how is it going to give them tax purposes? Is it all right? The SMA is going to do tax loss harvesting. It's in his brokerage account, I'm assuming?
Yeah, I think that's what he said.
So he's got $410,000 in a taxable account.
Yep.
I don't know. In some cases, if it's actively traded, it's not going to be tax efficient. You're probably
True.
going to get more income and interest and dividends on the tax return.
Probably. Yep. So anyway,
I guess I need a little bit more information. But he's doing a hell of a job.
yeah.
What Don needs to do is figure out a saving strategy and don't worry too much about the product. I agree with you, Al. I think he'd be just fine keeping with his low cost diversified, index funds. That's probably going to produce a very good return for you. It's going to be tax efficient. What I need to understand is that, man, if you want to spend $170,000 per year from 55 to 65, that's a big nut to crack. And you want to retire in 15 years. So it's a saving strategy. It's understanding how much money that you should be saving on an ongoing basis and where you should be saving that from, either a taxable, tax-free, or tax-deferred. And then from there, that would be determined what target rate of return should I be thinking about as I'm accumulating the wealth up to that time point. Is it 6%, 8%, 10%? And then from there, create the diversified portfolio that you need. And then from there, you pick the product. Should I go into SMA? Should I go into mutual fund? Should I go into ETF? Should I do my own direct index? Should I buy an individual stock? So I think there's a lot more steps that I would take if I were you before I jump into the product. It sounds like he's getting pitched a product by a broker or by maybe a buddy or whatever. Hey, I got this SMA. It's going to be really tax efficient and give you more growth. Hey, that sounds really good. But I think there's more planning. People put the cart in front of the horse in most cases.
Yeah, and I would say, and I'll just do a little disclaimer. So in a case like this where you're talking about big numbers and a lot of years, don't take our back of the envelope analysis. Get some real analysis done on this and figure out what your goals really are, what you really want to spend. The fact that you got a big pension at age 65 means that you can have a higher than 4% distribution rate for probably 10 years like you want to. It's just that you're going to have to map all this out to figure it out. I agree with you, Joe. It's just a matter of figuring out what the goals are, and then you start working backwards. What are the investments to achieve those goals? And then you can figure out ETFs, mutual funds, SMAs, direct indexing, however you want to do it. But start with the planning first.
Awesome. Yep. Well, thank you everyone for your questions. That's it. I got no more gas on the table.
Yeah, it was. I think you did a great job,
Okay, thank you.
Particularly considering all that you did today already.
Thank you, Al. Andy, thank you very much. Wonderful job. We'll see
Thank
you
you.
guys next week. Show's called Your Money, Your Wealth.
Tune in next week as Joe and Big Al spitball on when Ron and Veronica can slow down on saving for retirement, how Scott can bridge the retirement income gap between ages 55 and 57, whether Big Juan and Frank and Jane can retire early, and how Juan can fund college. It may seem on the surface like everyone that writes into YMYW has similar questions about when they can retire, how they should invest, and whether to do Roth conversions, of course. It may seem like just getting a spitball is all you need, but notice how everyone has a different story, different needs, different goals. And a spitball is on average, 6-7 minutes, including Joe mispronouncing your name and talking about your cars and your drinks? That's not enough to base your entire future on. That's why scheduling an in-depth financial assessment at Pure Financial Advisors really should be your next step. It's free, just like a spitball, and you can even participate from home, just like a spitball. But a financial assessment is a one-on-one with an experienced professional on Joe and Big Al's team at Pure. They'll review every aspect of your finances with you. They'll work with you to craft a retirement plan that's tailored specifically to your needs, your goals, your risk tolerance. Click or tap the financial assessment link in the episode description and schedule yours today. Future you deserves it. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this podcast and does not represent that the securities or services discussed are suitable for any investor. As rules and regulations change, podcast content may become outdated. Investors are advised not to rely on any information contained in the podcast in the process of making a full and informed investment decision.